Hey, welcome to the video. I'm glad you joined me today. And today we're going to talk about the presidential election here in the good old US of A and how it affected the stock market. And quite an interesting thing here, which is not only important for the presidential election, but also some good trading lessons. So let's look at what happened right around the election. So the election was actually on November 8th. So that, actually, what happened was, this is the interesting part, right before the election, actually for quite a while before the election, of course they're talking about who's ahead in the polls and so forth. It was a big deal. One of the most interesting conversations, I'll use a nice word, pre-election here in the United States for quite a while. And so the market had been coming down. Okay, now, remember, here's the 7th. And the 7th was the day before the election. The election was on November 8th. And as you can see here, the market rallied pretty dramatically. We got a big bullish bar here after coming down a little ways from there to there, kind of a neutral bar here. That is a bottoming candlestick bar, but still, point is, before the election, the day before the election. Now, if you were listening to the news, people were calling this the Clinton rally. The Clinton rally, because all the polls, or almost all the polls, the vast majority of the opinion was that Hillary Clinton was going to win the election. And the market participants like to get on board before something happens. This has actually got a term called the Dow theory, and more commonly it's known as buy the rumor and sell the news. So people were buying the rumor that Clinton was going to win. It was a sure thing, done deal, over and out. And that the market must like Hillary Clinton, Secretary Clinton, that it would rally so dramatically. I mean, just compare this bar with the bars before it. That is a very bullish bar. It's the most bullish bar on the chart for months. So therefore, they were saying, oh, the market likes that Secretary Clinton is going to win, because that's the day before the election, and everyone was sure that she was going to win. Okay, let's see what happened after that. So then this is the day of the election, and so a little less enthusiasm. Definitely still, market moved up and made a higher high and a higher low. It closed above the open. Where did it go? Where did it stop at that day? It stopped at that red line. Now, is that some magical ancient Phoenician numerology line? No, that's the 50-period simple moving average. Wow, real complicated. So the 50-period simple moving average is one of the most commonly used moving averages. And so if you go back over here in time, you can see as well that the market held the 50-period simple moving average there as well. So when it comes to support resistance, you don't really want to use things that are not used by other people. Support resistance works for one reason. And the market logic, as I call it, that support resistance works is because a lot of market participants see it, and the more people that see it react to it, either with buying or selling or profit taking. So when it comes to support resistance, you don't want to use anything secret. You want to use something that everybody sees because it has a self-fulfilling prophecy to it. So again, we just see this all the time with the 50-period simple moving average. I know it's boring, there's nothing exciting about it, but a lot of times boring works. Just simplicity works. We don't have to be all fancy schmancy. In fact, when I went to the Chicago Mercantile Exchange, hired a floor trader to work with me, got an apartment out there. Man, my trading was really sophisticated back then. I learned what he and his friends were doing, and it was frankly brain dead simple. And I came back humbled, and because they were making a lot more money than I was, and I just thought, wow, okay, I've got to really go back to simplicity, and that's what I did. So this is one of those things, a simple moving average, 50-period simple moving average. So, okay, now let's see what happened after that. So that's the day of the election. Then the day after the election, bam, wait a minute, but Donald Trump won. Right? And nobody was quite sure. Well, by the time the market closed on Tuesday, the day of the election, the results were not all in yet. But the day after the election, the results were in. And what? The market went up. So now they called it, guess what they were calling it on the news the next day? They're calling it the Trump rally. They're calling it the Trump rally on the news. So we had a Hillary rally here, and we had a Trump rally here. And so the question is, did it really matter who won the election for the stock market? Either way, the market went up. And so it wasn't a Clinton rally. It wasn't a Trump rally. It was just a rally. And there's a reason it went up, by the way. And it wasn't because of Hillary or because of Donald. So let's look at that. By the way, we'll just see what happened after that, too. So market goes up, up, up. Actually, I need to rescale here now a little bit. And see where we are today. Okay, so now we've gone up here. Market get more narrow range. Volumes taper down a bit. And why? Because we're at a horizontal resistance level. And that horizontal resistance level just means a previous high. A previous high in the market. Again, that's something you always want on your charts because it's very predictable that, again, everybody sees it. And therefore, as the market approaches it, people get more cautious and you don't get a lot of buying into it. So why did this low actually come in? Well, sometimes technical analysis can be a very amazing thing. So let's see here. Let's add another very, very complicated secret. This is an ancient secret Babylonian numerology. Do I have it here? Yes, I do. Good. Okay, great. So there it is. The 200 simple moving average. Let's add that on and see what happens. Oh my gosh. Amazing. Isn't it great to have these secret indicators right there? That's exactly where the market bottomed out, at the 200 simple period moving average. So those are the two most commonly used moving averages, especially on daily charts, weekly charts, and monthly charts that traders look at, 50 and 200. And guess what? It works. But why does it work? It's no magic to it. It's just that everybody's watching it. So as price comes into those levels, people are buying, selling, and taking profits. So I encourage you to have those two moving averages on your charts, especially long-term charts like these. I also include personally the 100 simple moving average, and I also use the 15 exponential moving average. But these are the two primary ones that provide just very reliable support resistance for the market to bounce off of. So again, you don't always need super fancy schmancy stuff. Sometimes just staying with simplicity is actually the best thing, and it works. So if you like this video, please understand it's absolutely free. You're welcome to all the information here. But if you got value to it, hey, please understand you do have a moral obligation to, well, share it with others. Press that beautiful share button below and share it on social media, and it will be spiritually rewarding when you do that. Believe me, you will feel really warm in your heart. In addition to watching this video on YouTube, please click the thumbs up icon below and leave a comment. I really love hearing your guys' comments. Even if you disagree with what I'm saying, that's cool. Hey, do that too. I just enjoy the conversation. And I'm also giving away one of my favorite trade strategies. It's called the rubber band trade. It has a very, very high win-loss ratio. It's a simple trade, just like all my stuff. It's very simple. You can learn it in about 26 short minutes. I'm going to give you that video with that trade strategy absolutely free. Simply click on the image in the top left corner, or if you're on a mobile device, then it's better to click on the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, then there's probably a link below or an opt-in form on the side. Anyway, once you do one of those things, I will personally email the video to you with the rubber band trade strategy.